Thank you, everyone, for joining us today. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. And for this session, we have an amazing panel. Many of you folks I've met with in the past. A number of you have been on my show before at NASDAQ. So we have Jeff Dorman with Arca. We have Ari Paul with BlockTower, Ryan Selkis with Messari, and Shilang Tang with LedgerPrime. We're going to take a look at taxonomy, valuation, and strategy as it relates to crypto assets. And I think this really has been the conversation this week. Jeff, you and I have spoken about this a number of times, how we classify digital assets and whether, we correlate whether it's within the crypto space or whether it's really traditional assets, but why everything always comes back to one particular crypto. And I think that's what we're all trying to figure out this week, and how we move from beyond that and kind of evangelize what the crypto space and what digital assets truly are, and not just one particular piece of it.
Sure. So, I mean, look, in a week like this, everything looks like it trades together, right? This is a correlation one, VAR shock, beta trade down. What is lost in a week like this is that for most of the last 2 years, that hasn't been the case. There have been clear winners and losers, very idiosyncratic sectors of the digital asset ecosystem that have performed differently than others. We put in our, we actually used Ryan's Messari company. We use his taxonomy all the time, talking about the different sectors from cryptocurrencies to smart contract platforms to DeFi, CeFi, Web 3.0, NFTs, et cetera. And there's pretty stark return spectrums across these different sectors. And then within the sectors, there's different types of assets as well, right? There's a very big difference between a cryptocurrency versus a smart contract platform versus a cash flow producing entity that we call pass-through tokens or an asset-backed token. So you have these different token types and you have these different sectors, and they all have very different factors and drivers of their ultimate valuation. And most of the time that plays out, right? In the same way that when you look at ETFs and you see, there's no commonality between a gold ETF and a healthcare stock ETF compared to a, junk bond ETF. The only commonality is that they're all ETFs, but there's completely different drivers of what makes those individual underlying assets within the ETF go up and down. The same is now true of digital assets, except for, twice a year when you have one of these big leverage, flush outs, when everything kind of breaks at the same time, you have super high correlation. From an active manager standpoint, from an investing standpoint, this is the greatest asset class ever to invest in, because you get idiosyncratic gains on the way up, but you get super high correlation on the way down, which means this is the easiest thing in the world to hedge. You can always have downside protection against a market crash, but win on the upside via research and real fundamental analysis. So nothing about this week, to me, looked different. But I think over time, and the data suggests this is true, over time, you're just going to see more and more bifurcation amongst the different sectors, the different token types, and the different assets.
And I would argue that's a good thing, right?
For sure. For sure. I don't often quote Jim Cramer. In fact, I've never quoted Jim Cramer. But the one thing he says that I agree with is there's always a bull market somewhere. That is going to be true within digital assets as well. There is nothing about what drives Bitcoin's success or failure that is similar to what drives Axie Infinity's success or failure, which is a gaming company, which is nothing similar to what drives Ethereum's success or failure. And ultimately, as more and more sophisticated investors get into this space, they'll start to recognize that. And ultimately, this asset class will just continue to diverge from sort of this, student body left, student body right type trade.
Right. And Ryan, I see you shaking your head in agreement there. Any follow-up?
No, I think Jeff nailed it, and he stole my line about how beautiful it is for investors in this market. And I guess the only thing that I follow up with is the decoupling. It tends to be cyclical too over very long-term cycles. So if you look at the rankings in any given sector or any corner of the market, you'll see everything going up at the same time, and it takes quite a while for some of these assets that are meme coins or don't really have much fundamental support to flesh out. But beyond that, it takes 4-year cycles to actually see a decoupling. And if you look at the rankings from 4 years ago, from 8 years ago, there's a lot of skeletons that are no longer around, and really the ones that have shown some staying power and actually feasible long-term viable models have gradually risen up the leaderboard, and of course, not only not died but thrived in the next cycles as they continue to build.
Right. So, Shilang, I was just going to ask you to follow up on that.
Yeah, I was just going to, completely agree. I was just going to quickly add that, so much about valuation and just crypto in general is about kind of capturing and monitoring the capital flows, especially the on ramps and off ramps, right? And something that's been kind of amplified in the past, let's say 6 to 9 months, are assets that retail have more access to, right? We saw all these big headlines recently about PayPal, Venmo, and Revolut, essentially offering products. But unfortunately, usually it's these, large cap archaic assets without any real use cases like Ripple or Bitcoin Cash or Litecoin or Doge that are added to these platforms. But because they're offered on retail platforms, while productive assets like Uniswap or Compound or Aave and Maker aren't, we do have to take into account this relationship, and so it's not necessarily all about pure fundamentals, but also, market structure, capturing the on ramps and off ramps and inflow of capital, and kind of tracing where that capital is going to ultimately. That does drive a lot of the valuation of movement of digital assets.
Right. So it sounded like what we saw over the past couple of weeks was more of a market structure thing than it necessarily was, any fundamental aspects of anything else, really.
Yeah, I definitely think that's true. I think it'll take some time for investors to pick up the pieces from an event like that, right? And I use the analogy of Peloton and Zoom, right? I mean, Peloton and Zoom in the first 3 weeks of when COVID really got serious and everyone was freaked out about a huge depression, and nobody knew that the governments around the world were going to start throwing trillions of dollars at the world. Peloton and Zoom stock got crushed in the first 3 weeks as well. And then over the next 9 months, investors realized, hey, who disproportionately benefits from staying at home forever is Peloton and Zoom, and the stocks did amazing. The same thing will happen here. There are going to be pockets of the digital asset economy that disproportionately benefit from what just happened. For instance, DeFi, right? You had $10 billion in liquidations on Wednesday alone, $1 billion of which happened on decentralized protocols. Nothing broke. Nobody went out of business. Meanwhile, the centralized counterparties had lots of problems with customers getting their assets in and out. But DeFi worked great. That is going to be a beneficiary of what just happened. You will probably, due to the China announcement that came out on Friday, miners who are operating in low-cost, clean energy jurisdictions will probably benefit from this. Even something like Arweave. Arweave is like decentralized Dropbox. They're basically giving you a way to store on blockchain and archive websites and other things that are free of totalitarian government control. That could benefit. So same thing will happen. Investors will start to pick up the pieces. Their risk will unwind. They'll start to find these pockets of strength. And ultimately, like anything else, it'll come down to the fundamental valuation and the drivers of the success of these digital assets on the way back up, just like it has been for the last few years, other than these systematic crashes.
Right. Ari, I want to bring you into the conversation. I just want to follow up a little bit more on what Jeff was saying, with China and the miners. This is, to Jeff's point, this isn't anything new. This isn't, newly interjected into the conversation. I just think it's part of one of the fundamentals and risk parameters that you have to trade around within the crypto space. I think there's always going to be that kind of level of noise in that market.
I've been happy to be quiet because everyone's articulated things so well. Jeff, it was a brilliant articulation of kind of my exact views. On the China question, I will say, I feel like I have no insight on this, and I'm not accepting that it's necessarily just a repeat of past headlines. So there is something different happening in China. I don't have anything to add beyond kind of what's public information, but I would be wary of just assuming that, just that China is changing policies. But certainly these are events that as a trader, you trade around. As an active fund manager, same with regulatory announcements, things will change over time. We shouldn't just assume that, people are sometimes make the argument of, well, this project survived this FUD in the past 3 times, and therefore we shouldn't worry about that. But that's not really how tail risks work. With that said, I don't know if it makes sense to expound on China, but I'll give just a sentence. So the worst case of China aggressively enforcing, which I'm not saying you're going to do, really, really pushing their population to liquidate coins would be temporarily bearish, but then long-term bullish. It would reduce a lot of the concerns around Bitcoin today of concentrated hash power, geographic centralization in China, all of that.
Do you think a number of these coins that are coming out there that have no use cases, they're more of a meme thing than anything else, does that hurt the underlying case for more established digital assets that are really driving the change in DeFi? Does that impact it in any way?
It muddies the conversation. It definitely scares institutions to some degree. Long term, though, I view it as it's part of every kind of tech boom bust cycle. It's just part of it. Same with I try to be a public educator and caution people against going 10x leverage long on Doge and that kind of thing. But at the end of the day, the extreme retail speculation, the fervor, the leverage, all of that just kind of comes with the territory. Really, the whole boom bust idea is true of basically every industrial revolution in history, every major tech kind of revolutionary period, personal computer, internet, railroads. So it's it's unfortunate in that kind of retail gets burned. Retail tends to come in at the top, buys the wrong assets, uses leverage, all of that. We can try as an industry to mitigate that with education, but it's just part of it.
Right. There's also a deep educational barrier, though, in the sense that anybody who read about the thousands of articles around GameStop in the last 3 months, for the most part, if you are an equity investor, you're like, oh, that's an interesting thing that just happened, but I can dismiss that because I know equities are real. Whereas if all you ever read about is Dogecoin, but you don't know about the other aspects of this ecosystem that are real, you might dismiss the whole industry. So to Ari's point, it definitely muddies the educational interest or it widens that barrier, I suppose, but it doesn't do anything to the underlying assets that are in this asset class. Like, they're real, they have real cash flows, they have real fundamentals, we can value them. Oh, by the way, over here, there's these 4 or 5 assets that the media loves to talk about every day, but it's not representative of the entire asset class. So I think once investors start to understand the other aspects, they'll learn to dismiss that, just like, almost every fund manager or professional investor largely dismisses, the Ripples and the Dogecoins. But for whatever reason, the media and retail love to talk about it, and it definitely muddies the educational process.
Right, and I'm really glad that you brought up the educational aspect of it, and of course with the media, and then you have to factor in influencers that have the ability to move not just one coin, but as we were talking about before, the high correlation within the entire asset class. Do you think that the community is doing a good enough job in terms of educating retail? Because we fall into this trap, and it's not just with digital assets, it can be with any asset class. Well, if you don't get it, then you just don't get it. Sometimes it's like what I see on social media, or just some responses that have been out there. So should the industry, should the communities be doing a better job at educating? Is it too technical? Is the barrier to entry too high?
There's constant kind of, call it disinformation campaigns in that. So in a bull market where you have retail coming in, new uneducated money, the loudest voices and most marketing dollars are spent on generally the least fundamentally sound projects. Actually, I would state that as a truism. Generally, the strongest fundamental projects do the least marketing, partly because the communities and the teams are most focused on engineering, innovation. Bitcoin being a great example of this, that there's no marketing budget, and core devs basically never ever care about PR, communication. They're focused on just kind of building the best protocol. Somewhat similar in Ethereum, they don't really have much public marketing. So I think it's as much as people like Brian do in helping provide data, and as much as other people here do in trying to publicly communicate. Basically, what I'm saying is I don't think the industry could do much more in the positive sense. You have people like Nick Carter writing great essays. You have just a lot of people who are trying to be helpful in the public education side, but you're always going to have really well-financed, very loud disinformation campaigns by newer projects that are looking to accumulate dollars. And I don't think that's a battle we can win. It's what I hope happens is that by providing the positive education, people are still going to get burned, but hopefully they get burned once and then they kind of realize what happened. And that's a common pattern. So you had a lot of people who got in, let's say, late 2017, got into a meme coin or a bad ICO, got burned, swore it off for a year or two, and then after a little bit of time, kind of reconsider and say, okay, because I saw someone, maybe a Ryan, maybe a Jeff, whoever, explain that this was a bad idea at the time and there is fundamental value here, they, instead of having to get burned once or twice or 3 times, they can kind of connect the dots. So I don't think we can beat the multi dollars of stimulus projects where it economically makes sense for them to spend many, many millions of dollars attracting retail inflows. I don't think we can stop that, but hopefully, we can provide counter education such that after people get burned once, they find their way to quality assets.
Thank you.
To Jeff's point, fundamental analysis really only matters on the way down when you're protecting gains, not necessarily on the way up, because we can build whatever tooling we want to at Messari and build whatever quality team and product is going to be kind of mass market adopted, and it can be the most helpful tool in the world. It's not going to change the fact that Dogecoin went up 100x in Q1. And that outperformed even like the savviest, smartest, most thoughtful, kind of long-term oriented plays. So in some cases, volatility just begets volatility. People want to play the crypto casino. And because it is a frontier market and there are technologies that make it accessible without going through the regulated financial system, and that's a feature and part of the sandbox, not a bug, you're going to have situations like this evolve. And it's an unfortunate byproduct. There's another... maybe I'm talking my book a little bit here, but there's another element where when the markets get overheated, infrastructure of all kinds tends to lag in terms of capital available to invest. So when it comes to like education resources, when it comes to like exchange infrastructure, when they break, it takes more than just a week or a month or a quarter even to kind of rebuild the foundation and really scale up to the next level and catch up to the market. So infrastructure is always going to be a laggard of sorts that puts the so-called governor on the golf cart and taps the brakes for some of these overheated cycles, because the next audience just can't get in because the infrastructure can't support them, either from a regulatory standpoint or from a trading infrastructure standpoint. And we saw that when all the major exchanges went down. We saw that when there were kind of breakages, across the universe and their data APIs that had downstream impacts, to us and other data companies as well when they had their shutdowns. So there's a lot that I think needs to continuously be invested in, but it's all about higher lows from cycle to cycle and year to year.
That's a great point. Because Jeff's point of DeFi really kind of excelled. So when Coinbase was inoperable for or having problems for 12 hours, all the major DeFi platforms, they had rocketing gas costs, but if you needed to do a transaction, you could. I thought it was a great stress test that DeFi really came out, frankly, stronger than I expected. I thought there would be hidden problems that get revealed during periods like that, and really came through with flying colors.
It's surge pricing during a hurricane, right? It's part of the system design, and it works.
We may have lost our moderator, so but I think we can just kind of continue with the conversation.
All right, so maybe I'll just hijack it and really put things off the rails. Oh, Jill, I was just about to have some fun with these guys.
But go ahead, it's all you.
No.
Hijack what?
I wouldn't steal your thunder like that, and I don't think they want me to do that. But no, we were just talking about the infrastructure spend and how that tends to be a little bit of a laggard in these cycles. Ari had made the point that DeFi performed extremely well under the stress of the last week, really, and even though the fees hiked up, it was a sight to behold and a good moment net for DeFi, which I agree with.
Absolutely. And as someone, I'll just continue on that for a second. I think it's interesting. All of us, speak to investors a lot, and there's thousands of them listening to these panels today as well. A lot of times when we just explain Bitcoin to investors, they don't necessarily understand it. Same with Ethereum. Same with some of the other layer one protocols. And quite frankly, probably everyone here, there's elements of Bitcoin and Ethereum and protocols that are difficult to understand. When you start to actually explain, DeFi and even some of the sports and gaming tokens and others that have real cash flow producing entities, you can see that aha moment. They get it because these are tangible businesses that have real revenues and real cash flows. And it's really interesting that now you have this period over the last few weeks where not only did you see a stress test and that DeFi passed incredibly, but you're also seeing the volumes accelerate across decentralized exchanges and the lending accelerate across the lenders. And you're seeing insurance being bought on Nexus Mutual. So you're seeing a real pickup in activity on DeFi. you've seen in a really viable stress test, and you have tokens that actually have real revenues and cash flows and yields that traditional investors understand. So it is not going to be surprising to me if DeFi is what ultimately pulls us back out of this. Because, again, these things have happened in the past, but generally when these have happened, the infrastructure wasn't really there, or the apps and the applications and the assets weren't really viable. And more importantly, you didn't have nearly as many investors looking at it as you do today. The perfect storm is here. We have, tons of investor interest looking at the space, real applications that have just survived a crash, and cash flows and revenues that are exploding to the upside. So DeFi should pull us out of this. How soon that happens, I don't know. I don't know. I couldn't put a timing on when and if the market goes back higher, but I can tell you Arca has been, buying these dips for real reasons. There's real fundamental strength supporting these assets.
Speaking of DeFi, let's talk about Ethereum for a moment and what's happening in July with EIP 1559. I've been getting a lot of questions on that in the course of my show, what the significance is. We keep hearing about the term deflationary. So in theory, it kind of sounds like, well, if supply goes down and the demand is there, what does that mean in terms of an investment for Ethereum? So if anyone wants to comment on that and explain on a high level what exactly is taking place in July and what we should be looking for. I'll put someone on the spot.
I'll weigh in. It's an incredibly important narrative. So I think the impact is less the explicit economic deflationary impact, short term at least. I mean, that is meaningful long term, but shorter term, it just as a narrative, right? So I think the biggest obstacles to Ethereum being viewed as institutional or as money is there's kind of two things. One, the fact that it hard forks every 6 to 12 months, which means, new code can be buggy. The idea that I'm going to trust, meaningful savings to basically code that is relatively new and updating very frequently. So that's one. That's going to take a little longer to fix. Eventually, Ethereum will stabilize and stop hard forking so frequently. And the other is the monetary policy, that an unclear monetary policy where we don't know the supply, we don't know what the inflation rate will be in a few years, and in general, where it seems to be higher inflation than at least the narrative of Bitcoin as kind of a fixed supply. So we're kind of checking one of those two things, which I think is really important for institutions. That narrative and actually another piece that's really important is there's always been this question of, does lots of activity on top of Ethereum necessarily translate to value for the ETH token? And that's a huge question for institutions, for any kind of more cash flow oriented investor, right? So great, all this cool stuff's being built on Ethereum. Why should that benefit the ETH token? And now we have an answer, right? So now activity on Ethereum will directly to reduce the supply of the ETH token. So I think that's an incredibly powerful narrative.
Right, and I would agree with you, Ari. I think that's where some of the confusion lies when you keep hearing about limited supply, then you hear about the word deflation and what it means from that perspective. It kind of, it is a little bit challenging to understand. So I'd like to get back into the market structure conversation. And Shilang, I know this is kind of like where your bread and butter is when you can think about the trading and the market structure end of it. Expand upon that a little bit more there, where you're seeing improvements, where the challenges continue to exist, where some of the opportunities are, if we're still in the very early stages of this, what could potentially be next?
Yeah, I mean, just kind of bringing the conversation, I guess, back to what recently happened. As everyone kind of expounded, it's nothing new, right? You have this massively growing asset class. You have new money entering the space. Capital needs to be deployed. People buy Bitcoin, other digital assets, pushing the markets higher. Some use leverage. It's a race to get long. Traders lever up. Basis widens. Funding gets expensive. You have ARB funds, borrowing cash, long spot, shorting futures, to play the bases. The curve's blown out, markets become overheated. Essentially the market's priced to perfection, right? And then you have some exogenous headline. In this case, it was Elon Musk, or it was China, but it literally could have been anything, because the markets were priced to perfection. And you have this massive kind of deleveraging and market unwind. Curves flatten, our funds exit, and then here we are, right? And the cycle repeats itself, and it's healthy because every time this happens, we kind of assess the damages. But as everyone pointed to, in this case, DeFi, for the most part, has held up well. These are productive assets. You have new money still entering this space. You have kind of a decoupling of As we said on the way up, everything's to a certain extent correlated. Everything's going up, and the way down, you have certain non-productive assets that are falling harder than some of the productive assets. So it is very healthy, and I think it's going to repeat again in the future. It's part of crypto. It's part of the ecosystem, but I think for the most part it's extremely productive for the longer term.
All right, I'd also like to bring the ESG conversation into this, and certainly that's been another hotbed as of recent. Jeff, and I know you've commented on this before. Is this more theater than it actually has a practical application? Can there be significant improvements in terms of how the crypto industry is managing energy usage? Are you hearing of any projects that are really making a foray into more renewable energy, more sustainable sources of energy?
Sure. I mean, first of all, with anything environmental and energy related, there's a lot of nuance to the discussion, right? Almost everything has some form of a negative externality on the environment, and it's just a matter of whether or not that's worth it to those who are consuming it, right? From refrigeration to the internet to everything, right? So, I think first and foremost, as a lot of people know, Bitcoin specifically is fairly more religious in terms of people's understanding and interest in it. You either hate it or you love it, and you're not really going to be swayed. So as a result, a lot of people come into this saying Bitcoin has no usage. Oh, by the way, it uses energy. Okay, therefore we have to get rid of it, right? Others are saying Bitcoin has a tremendous usage, right? This is a non-sovereign form of store of value and potentially money. And I'm willing to extract some negative externalities from an energy standpoint in order to keep Bitcoin afloat. So from that standpoint, I think first of all, people have to take this more pragmatically about what it is. Then you go on from there and say, is this more political theater or not? And for example, I think the largest ESG ETF is about $20 billion, run by iShares. And if you actually look at the stocks that are in that ETF, it's like JP Morgan and ExxonMobil and Facebook and Google. I mean, not exactly the most environmentally friendly companies are in that ETF, but because they somehow passed we're less environmentally unfriendly than others, therefore we can be included in here, right? So a lot of that then becomes narrative. Every single person in the world will tell you, I care about the environment, but whether or not they're actually doing something about it is another story. So I think that is going to take some time to really go further in terms of whether or not this is worth it. The other element of it, though, is ESG. People often forget the S and the G component of it, right? So we've addressed the environmental, but what about social and governance? Well, digital assets, by definition, are very socially friendly, right? This whole idea of democratizing the wealth and the and the access to things like DeFi and banking, or to getting the cash flows of a company that you helped bootstrap, as an early developer or as an early consumer. We talked recently in one of our write-ups about Airbnb and DoorDash. A couple $100 billion of equity value was created for shareholders. Meanwhile, the everyday people who made those companies work, right? In Airbnb's cases, it was the people who own homes and people who vacation. In DoorDash, it's the people who cook food and ride bikes to deliver food. They didn't benefit at all. In digital assets, it's the early adopters, and it's the developers, and it's the users who benefit financially when these companies and projects work. So that's great from a social standpoint, right? From a governance standpoint, what could be better than decentralization? That you actually have a voice, right? In the shareholder world, you have to go activist and overthrow a board to get a vote. Here, if you own tokens, you get to participate in a vote. That's a governance issue. That's a positive. So, Arca has been working on a paper that is probably going to be out in the next couple of weeks that addresses all of these different components. But, I think there's a lot more to this ESG conversation than just Elon Musk said Bitcoin is bad for the economy, therefore, for the environment, and therefore it is.
Yep, you and I covered this before a couple months back, but I would agree with you wholeheartedly. ESG is so arbitrary. Even if you look at it from a more traditional mindset, there's not even a data set where there's any sort of standardization across the board. So I think not only the practical applications of these different projects that we're talking about, but if you really want to bring that ESG narrative in there, what more from the S&G perspective can you possibly ask for. I would agree with you there, and I think that, the arbitration, the very arbitrary nature of it is what makes it really challenging, and not only for digital assets, but I would argue for a number of other asset classes as well. I just remember. Oh, I'm sorry. Go ahead, Ari.
So we're near a tipping point where renewables start becoming cheaper than fossils, and by near I mean over the next decade. I was in a former life an electricity trader, not an expert on power, but was kind of in the weeds of it. And the consensus of experts is we're very, like, if you look at a chart, for example, the marginal cost of electricity from photovoltaics, it's basically fallen in half kind of every 4 years. And so 30 years ago, photovoltaics were incredibly inefficient relative to fossils. We're very, very close to the crossover point where renewables have become the natural choice. And the thing it's two things that's causing that change. One is technological innovation, just better engineered renewables. And the other is economies of scale. So I would actually argue that Bitcoin is incredibly renewable friendly in that it's been the biggest subsidy, the biggest incentive for renewables ever. Because most electricity basically needs to be produced near where it's consumed. Electricity is very hard to transport long distances. And most industrial uses have large population demands. So either the electricity needs to be transported to a city for consumption or to industrial plants. There's kind of two exceptions. It's basically Bitcoin and data centers that can be located anywhere in the world and don't have to be, basically they can be located in Greenland next to a geothermal plant. They can be located in the Pacific Northwest and make use of hydro. And Bitcoin even more than data centers, because data centers need a decent number of employees, whereas a Bitcoin mining farm, you need 2, 3, 4 people. So what that means is that Bitcoin is naturally the electricity usage that is most flexible and can most easily be moved to remote renewable sources. And so that incentivizes the economies of scale and the research to accelerate that kind of crossover to renewables just being economically the most attractive option. So I think this is going to happen regardless. Bitcoin is accelerating the switch over from fossils to renewables globally.
Right. And I'm sorry, go ahead.
Well, the other thing that I was going to add is I think this is going to be the shortest cycle of fear, uncertainty, doubt around any one kind of risk factor for crypto of any of them, because so many of these forces are playing themselves out naturally. Right? If hashing power does move out of mainland China, or the coal-powered plants there become less important to the overall health of the ecosystem, that's one data point. With Ethereum and many of these other up-and-coming networks, the shift to proof of stake is already underway. So it's a complete non-factor for some of these other ecosystems. But even double clicking on Bitcoin, which is really going to be in the crosshairs for the foreseeable future until this is kind of provably de-risked. One thing that's interesting is between the move from China, if it is actually affected, which it seems like there is some movement, the relative percentage of miners as the overall GDP in the Bitcoin economy continues to shrink over time. And more of the fees are generated by the big exchanges. And there are other major financial players whose flows have increasingly overtaken that of the miners. And so what you could very well see is other entities, the Coinbases of the world, the major exchanges, the DCGs, the Galaxies that already have some mining operations in their conglomerates, might even be fine operating at break even or pretty marginal profitability levels, because this is part of their business that is strategic, it's core, and it's going to help with the ESG thesis as part of their broader portfolio approach to expanding the health of the ecosystem and their core businesses that are massively profitable. So I think there's a confluence of factors that make this less risky than ever before. And it just so happens this is the first time this narrative has really picked up steam. And it's going to last 6-12 months if the market cycle itself, to Ari's point, just doesn't play out even sooner than that if there's a spike in the price of fossils.
I mean, even listen to like NFT marketing, and the first thing that you'll hear is carbon neutral. This was created, with no impact on the environment. That's almost the pitch before the actual, content behind the NFT. So I think all of you guys are certainly onto something there. I just want to remind.
Can we just agree that's nonsense, though? that can we just agree that marketing line is nonsense?
Okay, keep going.
I mean, that's what dying chains do when there's no one building in their ecosystem. They talk about the fact that you can mint an NFT for the cost of a snowflake on the tip of a polar bear's nose, or whatever that meme was from mid-March. It's just completely ridiculous. The fact that you can equate any individual transaction to carbon spend versus zooming out and just looking at the overall security of an entire network that's humming on autopilot, it's just a false choice. So anyway, I think that's just marketing nonsense for also ran ecosystems versus a serious line of inquiry.
Right.
It also ties back into your, Jill, you'd asked earlier about the social influence. I mean, that's another aspect of this too, right? I wasn't there when Warren Buffett was 20 years old, but I'm pretty sure he didn't build a Twitter account before he built financial success. So, you have a lot of people with incredible influence right now over this market who haven't never really proven any success as an investor or an environmentalist or any of the categories that they are building success upon. So this is new to have social influencers with absolutely no credentials driving the discussion, because this is only a 5 to 10 year old industry, right? We don't have the Warren Buffetts or the Bacons or the people who have had huge success across these platforms then become the celebrities. It's working in reverse, and that can be incredibly damaging if you're following the wrong people or listening to the wrong narratives. And as you said earlier, because of so much, I don't want to use the word charlatan, but maybe I should, because there's so many people out there just looking for their own personal brand, they're going to hop onto any narrative they can hop onto. And ESG is as good as any for, dying chains and others with ulterior motives other than the growth of this asset class.
Right, and I'm glad you brought that up, because I've seen this, especially with the advent of social media. Some people are just really good at marketing, especially, I would say, Gen Z, younger generation, if you will, who grew up as digital natives, and they just know how to market and hop on trends and so forth, and literally pitching, let's say, even basic financial literacy, advocacy, and education, espousing certain narratives that are out there that we know they're falsehoods, but meanwhile they are said influencers, and there is some significant fallout that comes from all of this, whether you're looking at digital assets or basic stock trading. So I think it's also the mediums that are available as well. Quick reminder, we have about 10 minutes to go here, so certainly want the audience to participate. Put some stuff in the Q&A, because I think we're at a really important junction with the conversation here. So if anyone has anything they want to ask, certainly put it into the Q&A. I thought you guys were hopping onto another topic around ESG or mining, and I might have cut you off. I don't remember who was saying what, but Shilang, were you about to say something? I thought I cut somebody off. No? Okay.
Oh, Jill, actually, I'm getting internal buzz that we have the time wrong. Our panel's supposed to be ending now, not 10 minutes.
Oh, okay. Well, I guess we made the invite longer. So we ended on a good note, on a strong note. I thought it was a great conversation. So I want to thank all you guys for being, playing your A game and for joining us this afternoon. And thank you, of course, Arca, for the opportunity.
Thank you.